Well, today we're going to start back on our transaction processing, and this is where we get into the work that involves the SUA. So we will be working with documents, we will be working with the journals. There's some amount of work involved. I'm hopeful that when you work through your pages in the module, you'll see everything you need to complete 2 transactions. One is going to be a credit sale, and the other one is going to be a cash sale. They're going to be handled differently, and the reason why we handle them a little bit differently is that when you receive cash in, you have to have another layer of internal controls. So with that additional layer of internal controls that exists, we have some steps or some additional work to do. I want to direct your attention before we get into this PowerPoint to what you need in terms of the booklets in your SUA packet. And when we look at the specific pages, and I've organized those, one page is one transaction and another page is another transaction. It will talk specifically about the documents needed and your completion of those documents, and it'll talk about the journal entries. But what I want to talk about now are the 2 what we called reference books that you're going to need. And you're going to need the basketball and you're going to need the football. And I said that you should use these and consider especially the one that says reference at the bottom, the football, as a textbook for the class. So for your textbook, then, for this chapter, we're going to start on chapter 3, and it's on page 33. So if you have that and can get to it and can open that, you'll look at this. It says on page 33, you'll have a box at the bottom, and it talks about the sub-cycles. So we're in a revenue cycle. I call it revenue cycle. They call it sales and cash receipts cycle. I call it revenue cycle because this is the term they're going to use when you get into your auditing class and when you get into your internal auditing class. And that's why I use that name, because I've worked in practice and I know it's called a revenue cycle. Within the revenue cycle, you have sales, you have cash receipts, you have sales returns and allowance, you have a bad debt estimation, you have a process that writes off the bad debt. So basically what we're saying again with this cycle is it's everything from the order, the potential ordering of something, or the lead up into the sales transaction, until the conversion of that sales transaction into cash. The first transaction we have is going to create an accounts receivable, and then we hope on that accounts receivable that the customer will pay. That's where you get the cash. In the second one is a strictly cash sale transaction. You have the sale and the cash receipt instantaneously. So if you had a choice, which would you prefer? And given what you know about time value money, given what you know about credit customers, I believe you're going to want the second one, where cash and the sale happens instantaneously or at the same time. So I said in AIS, you have to also think about the things that aren't so smooth. So this is the smooth thing where you create an accounts receivable and hopefully you get paid in the future, or you have a sale with a cash receipt. The things that can go wrong include those things that are, a customer not paying on their account, it becoming an uncollectible account that needs to be written off, and the fact that if you have an account receivable, because we use accrual accounting, you have to record in advance your estimate of bad debt. Another thing that can happen that you don't want to happen is a sales return. So you have to make an adjustment for that, and you also have to sometimes give credit because of the merchandise that you shipped was substandard. These are examples of the things that you really don't want to happen, but you have to recognize at the onset they're going to happen. So we're going to handle all those things when we talk about revenue. It's going to be a series of PowerPoints. This PowerPoint is going to be very short, and it's going to be we're only going to talk about in this module the first part of the PowerPoint where you have the sale transaction happening. So back to the book then on chapter 3. If you turn the page over, you're going to be on to page 34. Here you see actions happening and you see the documents. So today when we work in the revenue transaction and we have the customer's orders coming in, you're going to see the first document they show is the customer purchase order. And then assuming we have the merchandise, then you're going to ship the goods. And when you ship the goods, you're going to have a bill of lading. This may be a term that you have only briefly heard before or not heard of at all. And then you have a billing to the customer. And I'm going to refer back to the flow chart in a minute and we'll talk about that. But I want us to keep in chapter 3 for just a moment longer because, I said the discrepancy again between what I call a document and your SUA packet calls a document. Notice they're saying the sales journal, accounts receivable, subsidiary, and general ledger are documents, and I don't. But the next step after you have the documents is you're going to then record it in journals. And when you record in journals in here, you are going to post to subsidiary ledgers at the same day in which you record it in the journal. You post to the general ledger later on, and that's the next step if you're looking at this figure 3.1. That refers to the end of month work. Okay, so we are going to stop really in here before the last step. The last step we're going to do when we work in the SUA is to record in the sale journal and the subsidiary. The first transaction is a credit sale. It will have a subsidiary and it'll be accounts receivable subsidiary account that needs to be updated. The second one is a cash transaction. The cash transaction does not have a subsidiary. You do not need to be concerned about that. So you won't have any posting to ledger. But that's where your work is going to stop. If you look on to page 35, it talks about the actions. It describes the documents. There are some essential things you need to learn in this class. And one of what I consider the essential things is to understand the documents and what the documents tell us. When you look at page 35, it says customer purchase order. This is different from our purchase order where we're ordering, say, merchandise. We are going to have purchase orders, and those are a part of the expenditure cycle when we are ordering merchandise. This is the sales revenue cycle, and in this cycle, we have customers preparing those documents, but they're sending them to us. They are buying from us. In the other cycle, we are buying from someone else. So it is the same document, but from a different perspective. However, when we talk about it, we need to understand here that this is the customer purchase order. So I emphasize that. The second one is the bill of lading, and it says other shipping document. So if you are ordering something from Amazon, you might see a shipping type document that's created by Amazon. And this shipping document is not a bill of lading. It's a shipping document, but it's not a bill of lading. A bill of lading is a specific type of shipping document. if you turn over to page 36, you see a typical bill of lading. You're going to be completing one of these, and when you get to the point where you complete it, the first one you complete, I believe, is going to be in your credit transaction. You can refer back to this page, but let's talk about this a minute. First of all, it's a uniform straight bill of lading. I said sometimes documents become legal, or legal are legal documents. That means they're binding. It means there's a contract involved. And if you look down at toward the bottom of this, right before you see the shipper carrier box, you see above it some tiny print. It describes its legal terms that are stated there, and that tells you that it's a legal document. If you go straight above that, it says subject to section 7 of the conditions. Yes, it's another legal document. And over to the left, note where the rate is dependent on value, shippers are required to state specifically. Yeah, so you have at least 3 indications on this bill of lading that this is a legal document. And so it is going to be binding. The other thing I would say about it is there's so much information on this. At the very top, it has a shipper number. So there's a shipper number. There's a carrier number. Who's the carrier? Well, the carrier is a trucking firm, and it gives down there Lucas Trucking Company. In this particular instance, Lucas Trucking Company is the truck that's going to come, and they're going to pick up the merchandise, and they're going to then take the merchandise and they're going to deliver it. Where are they going to deliver it? They are going to deliver it to Taylor Products over there on the left. As you work down, look at the bottom here. It says the carrier, Lucas Trucking, and there's a place, Joe Driver. Joe Driver, they're being kind of funny here, aren't they? Is the truck driver who's actually going to pick up the merchandise. If you look in the middle part, it talks about the vehicle number. So Joe Driver is driving a vehicle. I'm assuming this is the carrier number or Department of Transportation number, some sort of identification for this particular company's truck that's picking it up. So now we have great evidence here, don't we, of what's happened, of where the goods are, who picked it up, and so it's a handoff is what it is. It's a handoff between our company and Lucas Trucking, and Lucas Trucking is then going to deliver it. So when we hand it over to Lucas, Lucas is going to take the responsibility of all this, for all this merchandise, and they are going to take responsibility for 4 cartons of frames, 2 cartons of photo albums, 6 cartons of digital cameras, and 1 carton of scanner. What you'll notice in this is they list things as cartons. Sometimes they'll list it as pallets. Think of it as big boxes. Think of it as a quantity that is going to be more like a wholesale type quantity versus an individual quantity. So when you have a sales document, you're talking in items. Here we're talking about groups of items that go into a carton. And it's not specific. It's not specific as to how many frames go into one carton, is it? And that's because the shipping company is not really interested in that. They want to know how much it weighs because they're going to charge by weight, and they want to know a general description of the contents of these particular, you call it cubes, cartons, pallets. They need a description of those things. In this case, it's cartons, and they're telling us what's in it, and they're telling us what it weighs. So in our shipping department at Aaron's, there is an understanding of how many items is going to be in a carton for each specific inventory description that they have here. That's your overview of this. And what's relevant here is not the price of the goods, it's the cost of the shipping, right? But it needs to tie in. It needs to tie in because it's going to go back to the invoice. I really wish they had put an example of a sales invoice in here, because you would see things that are all tied together. Go back to the previous page then. You notice they have a customer purchase order, a bill of lading, and a sales invoice. In this cycle, for a revenue transaction, you have the three documents that are all going to be tied together. Now, if it's a credit sale, you're going to have cash coming in at some other point, and that's going to tie into all of this too. Okay, so this creates what we call the audit trail, and if you had databases, you would have separate links in between these invoices if you had a database. Wow, I took 16 minutes and I haven't even started the slides. That's not good. The other one I want you to pull out, the other booklet, is your basketball. When you start working through the transactions, you will be working on page 18 and 19. So go ahead and keep open your football and open up your basketball to 18 and 19, and we're going to proceed then ahead. So we need to understand the processes, the documents, and documentation. And documentation is on 18 and 19 because that's the flow chart. The flow chart again in basketball. And then there's links between this and other cycles because you are going to be taking merchandise out. You're going to be shipping the merchandise out. So there's going to be some linkages there. And then we're going to talk about internal controls for this cycle. And there is also a gap, sort of a recognition, because something needs to happen for you to record it as a sale. And I call this the big D, and the big D is delivery. Now with the bill of lading, it's a handoff that happens at the point of shipping. So you know the term FOB, shipping point, that's really what's happening there. But usually whenever we see sales being recognized, I say think of the big D, and that is delivery. And for us, it's going to be shipping point. And then we are going to look at the documentation and the flow charting. I don't specifically ask you again in here to create flow charts, but as we progress, you should get an understanding of how they look. These are the processes that we had described a moment ago, and I won't go over them again. These are described quite well within your reference book, your football, and it's in chapter 3. So you're responsible for understanding these things. This particular module is going to be about sales, but we have to understand that the other 4 things will also happen, and we're going to have processes for them. In your SUA, when they start the flow chart, and you can look at this on page 18, they start it with receiving customer purchase order. Now, I'm going to tell you that it needs to be seamless, and you are going to have some sort of an inquiry system or a way for the customer to learn more about what is being sold. And the other thing is they need to know prices, they need to know whether things are available, how much it's going to ship, when it's going to be available. And again, I'm going to refer you back to what your knowledge from ordering items online. When you order online, what are the things you would want to know? This needs to be connected into the AS so it's seamless. In some instances, there are legal systems involved. It's not just in merchandising, again, where you use an AIS. Sometimes it's manufacturing, and oftentimes There are long-term contracts involved. In the service industry, for example, when you enter a contract for your cell phone, think of that. You had to sign some documents, did you not? And that is a part of a legal system. Not all sales systems are going to have these contracts involved. You will have contracts, but oftentimes, as we just showed you a moment ago, the contracts will be within the existing documents that you have in the cycle. The order entry. When the order is completed, when you order online now, they try to get you to create an account, don't they? What they're trying to do is they're trying to create a database. They're going to create a database about all the sales that are made to you. They're also trying to put things into some sort of a credit system. And often the credit today is done through credit card transactions. From your side, it's still buying on credit. For them, it's almost a cash sale because the credit card company is going to pay them quite quickly on that purchase. Now, if things are going to be bought, they are going to have to be shipped. And the question is, where is it going to be shipped from? Is it available? Because again, it has to, when a customer wants to order, they want to know when can we get it. So the inventory records are going to have to be updated. There's going to be links also to inventory. So in this discussion, I hope you're beginning to see how the AIS has to be integrated with the various functions that are happening in the company. Now, if it's on account, if they're not sending in the check and it's not a cash sale, which is our second transaction, you're going to have a billing process. And whether you have the billing process being kicked in or not, you need to record the sale. And so it needs to be recorded. As it's recorded, you also have cost of goods sold entries, you have sales tax that needs to be recorded. So there's a lot going on that happens behind the scenes. Now, I'm going to start talking about getting you kind of geared up to when you have an IT approach. You're going to say, all of this stuff is integrated and there's a lot to it, but does the customer see all that? And when you're buying, you don't see very much of this, do you? You see the inquiry, you see the order maybe, or the billing, and you see maybe some shipping documents, but all the rest of it that you never see. So it's called the schemata or the viewpoint, and the viewpoint of the buyer is going to be quite different from the viewpoint of the seller in this. When we look at this, this is a very, very simplified flowchart for you. And it's very simplified because generally we're just going through yeses and nos. But I like it because of its simplification, and you can clearly see where the swim lanes are. So these are separations or segregation of duties that are happening here with the swim lanes. You can see sales. Again, their PIL is receiving the purchase order. There would be inquiry leading up to that. And when the sales department gets the order, they're going to find prices. They're going to see what the prices are, and hopefully in the inquiry there would have been discussion of prices. And they are going to prepare what we call a sales order. From the sales order, the credit department needs to tell us in some way, if it's a credit sale, whether they have credit or can be extended the credit or not. And so there's a decision that has to be made. Within your SUA, when you start looking at the subsidiary accounts receivable, you're going to see something called credit limit. So the credit department establishes the credit limit. And if the customer does not have available credit, then that purchase can't be made. It's very simplified here because you see there'd be some people who would want to buy on credit who are not already set up in our system. If they aren't already set up in the system, obviously you need to go through a process to see whether they should be set up in the system or not. Now we get to the inventory. do we have it? And do we have it in stock or do we not have in stock? And this is again simplified here because if we don't have it in stock, you'd probably go back to the customer and say, you don't have it available for shipping today. It will not be shipped till such and such a date. Today, you see this when you order online, and when you order online, it's really happening back in the inquiry. So way back over here is when this really kind of kicks in for you when you buy online. If we have it though, then we can ship it. And if we don't have it, we can't ship it. Before you ship it though, there's another distinction I want you to see in here. I want you to see the distinction between warehouse and shipping. Warehouse has to be secure. This is a secure area. So security of our assets is one of our internal control activities, and we need to secure our inventory. We keep it in the warehouse. Whenever warehouse is notified that something needs to be shipped, and there are documents that are obviously not showing up in this flowchart. This is more of a process flowchart. We are going to retrieve those documents from the warehouse. They're going to be shipped over. They're going to be sent over to shipping. And then shipping is going to look at all the stuff, and they're going to ship it out to the customer. And other thing I wanted to bring out to you when you look at this, the absence of the documents is one thing that's quite obvious. And this is fine. This is a process flowchart. So the documents aren't that important in this. You're going to notice that when we do a process, they have it in a square. So in some flowcharts, you're not going to see this as a square. You're going to see something else. And that thing is going to be a trapezoid. So don't be put off by that. What they're saying here are these are the processes that are happening. These are decisions that are being made. This is the start. Instead of using connectors here, they're actually able to draw the arrows, and the arrows go from one to the other, and you go through this thing, and you see the processes that are happening. Whenever you have processes, you should have documents. So as we look at this, you're going to see there's things that are happening. For example, verifying price, where would you go to look for that to verify price? That's the price list, and we have it, and you'll be using that. And it's a separate sheet of paper. I'll tell you this, when you start working with the price list, make sure if it's a sales transaction, you're using sales prices, and make sure if you're ordering the inventory item that you're using the cost. So when you look at the document, you'll see that. The credit department document, they will probably be signing their approval or not to the sales order. You're going to be doing something like that, and you'll be initialing it. Now, inventory control, we don't have a lot of documents within the SUA on that. There should be some documents involved, internal documents, internal communications. Shipping document, you will have the bill of lading. Billing department, you are going to have an invoice you're going to prepare. And then you're going to put things in journals, and they will be posted to the ledger. So it's a little bit not complete here as to what everything we will be doing, but this is a wonderful overview of what happens in a sales transaction. So here are the documents you're going to see then. You're going to see that customer purchase order. You are going to see the bill of lading. You're going to create a sales invoice. The credit approval with us is going to be happening earlier on, so there's not an authorization form that's actually going to be included. Another thing that happens that isn't showing up here is a pick list. What is a pick list? The pick list is what we use so that those individuals who are picking out the items from warehouse to be shipped can do it. They aren't interested in prices. They're interested in the items that need to be picked out. I think of this as, some of us when we go shopping have a shopping list, and we go through and we look at the shopping list and we pick all those items out, and those are the things we need to buy. Of course, we buy things that aren't on our list, but here you only pick the things that are on the list. And you pick the things that are on the list and you organize it. It'll be organized, and it'll be organized for shipping. Now, I did not speak about this on the previous slide, and I should have. When you ship things out, it's called shipping. When you get things in, it's called receiving. So you have one big warehouse, and you need to think of that as two doors. You have a door going out and you have a door going in. Instead of things going directly out and coming from directly in, we create layers. And the layer provides additional security. So that's why on the previous slide, we had shipping being separate from the warehouse. So you have a warehouse that's very secure, and then you have these other areas that are nearby, and one of those is shipping, and one of those is receiving. And next time you go buy a very large plant, it might be, say, 3M. It might be, I'm trying to think of another big plant, Leggett and Platt over there in Carthage. Go by one of these big plants, you'll see a sign. It'll say shipping that way, receiving that way. Well, obviously, it's because they want the big truck flow to be good, right? They don't want them to go and be trucks facing each other, one trying to get in and one trying to leave. But they also do that because they're going in separate places. Shipping and receiving are kept separate. And they're kept separate so that there is control, adequate internal control over the merchandise that's coming in and the merchandise which is going out. Okay? So that is the concept there. And when the warehouse crew is going to pick items for shipment, they have a pick list. Often this is done on an iPad or a computerized system now. The packing slip includes all kinds of information that will help with the shipping of things out. I discussed a shipping log before and how in internal controls it becomes important because it keeps track of all the shipments, and it says chronological listing. That means by time, by date, and oftentimes things are scanned out now. So there's a scanning which is done. Do you still have a shipping log? Yes, you still have a shipping log. Now, this is a question, and I'm not going to specifically answer A, B, C, or D at this point. What I want us to do is to go back to the flow chart. And this is page 18 and 19 of our basketball. And I want us to look at this because what you notice here in sales, and first of all, that's Nancy Ford. She's going to be shipping and billing. Usually you don't have that happening. But you're going to see here that in Nancy Ford's work, as she does her work, that the customer purchase order happens, and this is coming in from the very beginning. The items are going to be picked from the warehouse, put in shipping, I guess. There's going to be a bill of lading prepared, but there's a connector going up to the next side, and there you have a sales invoices being created, and then you have the shipment occurring. Now, when does it get in the general ledger? And that's what it says here. When is the sales invoice completed? Well, it looks here like the sales invoice is actually completed at the top right column, if you will, of the total swim lane being the total page 18 here. You see at the top right column, prepare pre-numbered sales invoice. That's when the sales invoice completed. When is the journal entry done? Well, you can go down here and you can see the you are going to make the shipment, so you're going to actually have the sale in legal terms. We're using FOB shipping point, aren't we? So the sale really happens right here with this trapezoid, ship customer order. When is the journal entry done? Well, continuing down here, you see she's not doing any journal entries. We go on over here and it says from page 18. Okay, now we're into Jim. What does Jim do? Now Jim is going to do the journal entry. So what we have is we have an invoice here prepared, and from the invoice the journal entry is going to be done. And when the invoice is prepared, then it's going to be shipped. So we have to be careful here, because with our particular thing here, the sale needs to be happening when the goods are actually shipped, which is over here on page 18, but it gets recorded on page 19 when Jim Adams actually gets that invoice and then does the journal entry. So what you have happening here that I wanted to bring to your attention is you have a cutoff issue. That is to say, it's possible you could have merchandise shipped, should be a sale recorded then, that doesn't get in the general ledger until over on page 19 with Jim Adams. This is a cutoff issue because if we stopped our financials and we have something that happens in between our year ends, so to speak, we have a shipment which goes out on December 31st and it gets to Jim on January 1st, then the sale would be put in January 1st when it should have been put in December 31st work. That's called a cutoff problem. So my point in giving you this question is to start thinking about that and how we could have a problem within the AIS at the end of the year. So there's additional end of year work that has to be done to address that. Every time we go through and we look at one of these chapters in our reference book, our football, we have authorizations and we talk about internal controls and internal controls that are related to things. When you look at this particular chapter, and I know you can hear me turning the pages because this is a kind of a long chapter, but when you get to page 46, it talks about these and it includes it for all of the revenue cycle. And what I'm having here in front of you is the specific things that relate directly back to just the sale transaction. So who authorizes a sale? Who authorizes the price of the sale? The credit limits. If you're putting a new customer in the system, who says whether we can accept the customer? And then segregation of duties. Sometimes I say CAR, sometimes I say ARC. I want you to know authorization, record keeping, and custody all have to be kept separate. So we have to keep the swim lanes and keep them all separate in whatever we do. In this particular thing, you're talking about in our second transaction, we have cash coming in, and cash is an asset we need to think about. And in the first one, we are talking about creating accounts receivable, and we are also talking in both of those about inventory. So when we're talking about assets, you need to think about those assets. And when we're talking about authorizations, it's authorizing the account receivable. And when you're talking about record keeping, you need to think about that doing the accounting function. And the accounting function, when it gets muddled with either cash or with inventory, it becomes a major problem. The documents. We have external document coming in. We cannot control the number which shows up on that customer's purchase order. The customer's purchase order is the number which that customer has assigned. Now, from that point on, though, we have a bill of lading number, we have a sales invoice number. These numbers are numbers that we create, and we will be doing those and creating those numbers in a sequence. So we know that if our documents, the documents we create, are missing, we'll know it because it's sequential. When we get to the receipt of cash, we cannot control the check number that the customer has on their check that they send to us. However, if we were to write a check, it's a combination of us and the bank that creates those numbers. So you see, anything which we create, we want to have pre-numbered, and that's a part of adequate records and documents. Secure the warehouse and the inventory, and also the access to all the records. Again, I'm not saying that custody and record keeping should be together when I make that statement. I'm just saying that you should be thinking about records as something that should be secured. Now, again, what a part of this we're talking about, one of the very important parts about that inventory is you have warehouse and you have shipping and receiving, all separate. This is the layer for security of assets. Independent checks and reconciliations. Before we bill the customer, we need to make sure we have the prices right. We've done our extensions properly. And one of the best checks after that point is actually billing a customer, and the customer comes back and says, hey, you got the price wrong, or bill a customer and then send out a statement and the customer has paid their bill and you're still asking them for payment. That will make your customers very angry, but it is a good check because it's coming from outside the organization. Someone outside is telling you have a problem. And this is a wonderful opportunity to have a call-in center for problems, or to have a complaint line. If there's some problem happening, it comes to the attention of the people who are in management, and they're saying, we seem to have a problem with our ordering process, or we have a problem with our cash receipts process. And so the customer complaint lines are also a good thing. Reconciliations, when we talk about inventory, we'll talk about doing that end of year inventory and providing a reconciliation of that. So these control activities, of which there are 5, are going to keep coming up again and again. My list is a little different from what we had in COSO, but this semester we're going to be using this list, and every time we do something, you're going to see it in the reference materials, and it's going to provide you with identification of how, just this guiding principle, you need to have all of this stuff when we start talking about AIS. Well, this concludes this part of the module, so you should be able to go in and start working on those transactions. All you need to do is work through your pages there in the module, and if you'll notice, you really need to keep page 18 and 19 open, because this is the flow chart that really guides you in what you do. In this SUA, you are going to perform many functions, and your functions are going to be the functions or the jobs of Nancy Ford, Jim Adams, and Ray Kramer. I tried to think of a way how I might divide the class into threes, and have teams. So I have a team of 3, and one individual be Nancy, and one be Jim, and one be Ray. But I really couldn't think of a really good way to accomplish that. So we're going to work through it the traditional way in which we do the SUA, or most schools do this SUA, And that's to have you as a student perform all of these functions. So as you read through the flowchart, you're going to be Nancy Ford for a while, then you're going to become Jim Adams. And then at some point, this is the bad debt actual write-off, we're going to do Ray Kramer. And so it's interesting how we're going to be doing all of these functions throughout the semester.